But hey, folks, if you like printing passive income, those juicy dividends from those wonderful Canadian monopolistic banks, we got some big news today. As we're going to be breaking down what has been going on with Royal Bank that finally got the approval to purchase the Canadian counterpart of HSBC. And there's some stipulations behind that as we also dive into the broad view of how the banks have been performing into the end of this year. And not only, but including, we're looking at ZEB, that equal weight BMO Bank ETF, because I'm kind of shocked if you look at the total return from 2009. The banks, obviously being some of the largest companies in Canada, have been propelling most of the returns over the long run, which I just think is intriguing when you look at the long rates of return. So that's a conversation you'd appreciate. As always, hit that like button, folks, because Royal Bank actually has not been moving that much this week alone, which was a surprise to me because on the 21st, there was a bit of pump in the stock because that's when the news dropped, but I really thought we would have seen more action, but that could just be a sign of, getting a little bit overbought here as we get into this wicked fast recovery from those October lows up 23%. Year to date now, we're back into the green by 4%, and we're pretty much only off the all-time high now by what? Just maybe 10%, which really isn't that bad considering from 2022, collecting dividends, you're probably damn near an all-time high at this point from a total return standpoint. But taking a look, Ottawa approves the $13.5 billion deal for HSBC, and it's very intriguing because we all know the deal fell through with TD trying to purchase, I believe, First Horizon in the U.S. So this is a big stepping stone, and Royal Bank being one of the the largest company in Canada, the best performing bank, this is only going to propel their revenue into the future. And there are some stipulations because basically they have to protect SBC's workforce and create new jobs. So they're going to establish immediately and fully implement within 5 years a new global banking hub in Vancouver, supporting more than 1,000 jobs. They're going to increase its client operations center workforce in Winnipeg by 10%. They can't be terminating employment unless it's mutual. They will not offshore any client-facing advice centers or retail back office positions. You also take a look at the consumer banking side. Use all reasonable best efforts to service and retain all current HSBC clients, retain and operate as RBC branches. So they can't basically buy it and strip it for parts. They got to provide the clients who continue as RBC clients with access to RBC's network of ATMs, maintain equivalent qualifications for fee waivers, enable HSBC clients who continue as RBC clients to transfer registered and unregistered products to another financial institution at no cost for up to 18 months. It's very just kind of blah, blah, the usual paperwork stuff. But I think the Canadian government was just more concerned about stripping it and firing people and kind of refining and dining. But I don't think Royal Bank really cares as much about that. It's just kind of continuing to expand their Canadian business because they are the largest Canadian exposed bank. A lot of the banks, like Bank of Nova Scotia here, have more Latin America exposure. TD's got a lot of American exposure, but Royal Bank is the purest Canadian exposure, which I think is what's led to the outsized performance and growth because they're taking advantage of the Canadian economy at scale when it comes to immigration, right? But you take a look at Bank of Nova Scotia here, we're covering off the lows as well. I mean, it's up about 14%, not seeing the same kind of gains as Royal Bank, but I arguably think some of these banks have the best runway and are still paying the largest dividends. You zoom out of the long run here, we still got quite a ways to go before full recovery, which I think we'll see a better recovery in the stock come the next earnings, primarily because the new CEO that stepped in has basically, he lumped a huge amount of loan loss provisions, stating we'd rather just jump it in this last quarter to make the quarters consecutively look much better moving forward. I still think there's some good buying opportunity that is still trading at a favorable discount for the EPS recovery we're likely to see, because you got to remember loan loss provisions have been really cutting into their earnings, which has been driving the stock performance. So I think that's what the new CEO is trying to drive. And I think there's going to be some success here. We're seeing a lot of that in Canadian Imperial Bank. It has been one of the best performers from the lows. I mean, it's basically giving back some gains. So if you've been buying it from the dip, basically from the midst of 2022, you're finally starting to see a lot of green come out of this. And again, the yields are starting to disappear as mentioned. Anytime these things start paying 7% yields, it's very short-lived because there's just not many companies out there that have payout ratios in the 50 percentile range that are yielding 7%. So unlike those other banks, we're still seeing National Bank start to pressure back toward an all-time high. From its recent peak, it's probably the best performer, only down about 4 or 5%. And it tends to be the case. National Bank seems to have some of the best growth, being a much smaller bank that's been kind of picking up in the Canadian economy. And we also have Toronto Dominion Bank here that, is trading down still and not seeing the best price recovery, down 21%. And I'm very kind of perplexed by this because I really think TD has some of the best and most stable assets of many of the banks and some of the best diversity with that U.S. exposure. And considering how much JP Morgan and Wells Fargo have really come back for the scale of TD, I'm just shocked that it's still kind of trading down, which means, potential buying opportunities here. But as mentioned, it's just good to own the broader banking sector. And I've always been shocked because I really like the ZEB ETF, even though Horizon came out with one And I've always just said that it's easier probably just to buy the banks individually because it's only 4 or 5 major banks. You can equal weight them, do it that way, don't pay any fee. There's the Horizon Bank ETF that's fairly new where they're not charging any fees up till basically July of next year. So that's another good way to get exposure. It's a bit of a new ETF, but ZEB here gives us the full scope of how these banks have been performing because this ETF has been around for so damn long. Now, the only thing I don't like about this ETF is the massive, maintenance fee here of 0.25%, which is far too high, in my opinion. It's one of the things that kind of keep me from buying this because, again, to pay that management fee to just buy the 5 banks because it's all they're really holding, it just doesn't seem that appealing to me considering that's all they're doing is just keeping them equal weighted. But still, take a look at this because it's kind of mind-boggling to think that from 2009, you put $10,000 into this over what has it been now, 14, 15 years. I mean, you're talking about a return to date that is sitting at around, what is that, $42,000? Or wait, sorry, the BMO Equal Weight Bank ETF is at $39,518. So over a 10 to 15 year period, you've turned $10,000 into damn near $40,000. And I have a good assumption that this is likely to continue into the future. There's still good buying opportunity in the discounts that I think exist within the financial sector because we haven't gone into an EPS recovery yet. And that's kind of the next leg of the market, right? So if we take a look at the holdings here, just to give you an idea, I mean, you could just replicate this on your own. I'm not telling you to buy this. It's not financial advice, but Canadian Imperial, BMO, Royal Bank, National, they're all making up 15 to 18% of the entire portfolio. And you could just replicate this one for one. But I honestly think there's going to be a lot of recovery still coming into 2024, especially once we get to the interest rate cut cycle, and especially once these banks continue to shake out some of the looser loans. But it's likely we're going to see some stuttering. I know this rally has been very nice to see, but this rally might be a little preemptively deserved if earnings don't start to recover. And again, we may very well see some spattered earnings across the banks, but I think maybe if loan loss provisions start to lighten up a bit, we're going to see continued recovery into the first quarter, right? And especially probably on these Q4 earnings. But I'll pass that question off to you. I'd love to know what you think about the Canadian banks, as always, in that comment section below.